First of all, thank you very much for having me here. I'm sure this will be an interesting evening. I don't know whether it'll be an enjoyable evening. I'll decide that 2 hours from now. I have to admit that I started work very, very early this morning on my column on a completely different subject, and it is now pretty late. So if I'm more than usually incoherent, that is the explanation. I always, before I start talking in the Netherlands in general and Amsterdam in particular, I like to remind you, particularly since I'm speaking in English, which is generous of you to use as your public language. I like to tell people that on August the 30th, 1918, my beloved mother was born in Amsterdam, and therefore I always feel a particularly strong sense of connection with this city and this country. And for this reason, it's a great pleasure for me to be here and talk to you. I've been asked to set out a case for radicalism. I've not been asked, thank heavens, to explain what the radical system I would prefer would look like or should look like. And the case I'm making is essentially very simple. It is that the system we have at the moment is inherently crisis-prone. The crisis we've just experienced is exceptional only in its depth and magnitude, not in the rarity of such events. It has huge costs, and the reforms that we have chosen since the crisis happened, though completely understandable, are in my view very defective in crucial respects. And for this reason, intelligent people should be thinking about more radical reforms, not because they necessarily will be introduced today or tomorrow, but because we should be ready and properly prepared when, and not if, the next big crisis happens, to do better than this time, which is essentially to put the old system back together again with an enormous amount of regulatory bells and whistles added to it. So that's very briefly what I'm trying to do. I should also say that I had this wonderful presentation which the organizer probably very sensibly took a third of the slides out. So if it looks a little truncated, blame it all on him. He obviously thought you couldn't concentrate for that many slides. Okay, sorry. I'm going to cover 4 areas, or 4 issues. First, why the monetary and financial systems that are intertwined with it. You've just been explained and know apparently already that the monetary and financial systems are more or less jewels of each other. Why it fails. Then I'm going to talk very briefly about the reforms that have been imposed, very briefly, because the very long section in which I go through all the 6 different buffers and so forth, capital buffers and so forth, has been removed. Then I will talk about why I think these reforms are likely to fail. And then very briefly, I'm going to talk about where we go from here. So to give you a point, to start with a point which I think you all know, the existing monetary system is essentially a private-public partnership. It's an old private-public partnership that unfolded over centuries, but really reached its fruition in the last century. It relies on the creation of debt-backed money by competing private institutions, which are also the principal financial intermediaries in our economy. These institutions are both supported and managed by the central bank, which is a monopoly issuer of public money, but as you have already been told, in normal circumstances, public money, that is to say the liabilities, if we want to call it, the money created by the central bank, is an extremely small part of our money supplies. At the moment, as it happens, this is less true because of something called quantitative easing, and today, publicly created money is a relatively large part of our money supply, though still only a small proportion of it. The central bank, though a public institution, is the banker to private banks, and private banks, apart from the government, are in all the cases I am familiar with, the only clients of the central bank. Private banks have a guarantee from the state of their liquidity. That's essential. That's how the central bank manages them. And also, as we've seen in many crises, again and again, they have a guarantee from the public finances. If it is deposit insurance or direct guarantees to provide capital in extreme stress, there have always, in major crises, been public guarantees. Over the last 35 years, there have been more than 140 major banking crises in the world, 140, and nearly all of these required public money to deal with. And because they have this guarantee, they suffer from a major source of moral hazard, because a large part of the risk that associated with their activities is borne by the public at large and is dealt with, managed by public institutions backed by the state. This chart comes from a report prepared by an organization, a group, if you like, called the Independent Commission on Banking. The Independent Commission on Banking was established by the British government in 2010, and it was asked to propose structural reforms of banking with a view to making it stronger, more resilient, more trustworthy than before. I was a member of this commission. Rather controversially, they appointed a journalist as a member of this 5-person commission. We came up with some recommendations which I strongly believe in. The ring fencing of retail banking from investment banking, also recommendations on increasing capital requirements, many of which have since become conventional wisdom. I would have liked to go further and would have liked to go further, but we did do some very good work. In the course of doing this work, we put together some quite interesting data. They relate mostly to the UK, but I think you'll find them quite revealing. So the first chart shows the state of the banking sectors of the world immediately before the crisis. Since then, these banking sectors have shrunk somewhat, but they mostly remain very large. And you can see there were a number of countries in which by 2009, Sweden, Switzerland, the Netherlands, and the UK, where the aggregate balance sheets of their banks had reached between 4 and 5 times GDP, which meant that individual banks in these countries had balance sheets close to the size of the GDP of their countries. If I take the United Kingdom, a very important example, extreme at the end, roughly half of that balance sheet was global assets and liabilities, and roughly half were domestic assets and liabilities. To put that in context, historically, the normal ratio of banking assets to GDP in the UK, that is domestic assets, had been about half GDP. So during the immense expansion of credit and debt associated with the liberalization period of the 30 years preceding the crisis, the balance sheets of British banks domestically increased 5 times faster than GDP. And this was not an exception, though extreme. That's the chart on the ratios to GDP that I was just mentioning, and you can see Sweden, Switzerland, Netherlands, and the UK right at the extreme. The US, by the way, looks relatively good. The main reason for that is the government-sponsored enterprises that provide all the housing finance are not included in those numbers. If they were included, it would look rather similar to the situation in many of the countries with enormous banking balance sheets. Now, the second chart, which is obviously crucial, shows what happened in the 2000s, in the period of euphoria that led up to the crisis. Periods of euphoria in banking are completely normal. They happen all the time. It's a feature of J.K. Galbraith's famous book on the Great Crash of 29. He discusses this period of euphoria, which leads to an explosion in the balance sheets and an explosion in leverage. That is to say, an explosion of debt relative to equity or assets relative to equity in the banking sector. And you can see that left to themselves, left unregulated, essentially, or largely unregulated, the banks in the UK, these are the UK banks, achieved a median leverage, I stress. The supposedly responsible financial institutions looking after themselves in a responsible way achieved a leverage of 50 to 1. That is to say, they needed to lose 2% of the value of their assets before the entire banking system became insolvent. This was a position of, I think you will agree, maximum insanity. We have since reduced leverage very substantially, as you will see. It's now about 20 to 25 to 1, and that might make you feel, well, we've got quite a safe financial system. But I would like to remind you that a leverage ratio of, say, 25 to 1, so or 4% equity relative to assets, means that a bank is insolvent if it loses more than 4% of the value of its asset. So, in my view, these institutions are very close to insolvency all the time. And that's completely rational for them to be as close to insolvency as possible because the ultimate equity risk is being borne by taxpayers. So why should they go to the great expense of raising equity, which will tend to lower the returns on equity? And if they lower the returns on equity, what bankers can pay themselves will be diminished. So what's the point of having equity at all? One of the things the regulatory system has to do is to fight against that tendency. Now, the outcome of the crisis that followed this, and all crises, tends to be devastating. I want to bring home to us, in thinking about why reform is needed, just how big the crisis costs have been in the case of this most recent financial crisis. And let me stress in particular, focus particularly on the UK experience, because it's the one with which I'm most familiar. Though I'm going to provide you with some figures which are, or a chart which shows something more wider. So first of all, the fiscal costs of having this crisis, mainly the result of the gigantic recession that followed the crisis, but also because of the costs of actually recapitalizing the banks. In the case of the UK, these fiscal costs, the costs in terms of additional debt associated with the financial crisis, were equal to those, very roughly, of the First and Second World Wars. These were World War-type events, not quite on the same size, but very much of the same magnitude. In fact, the financial crisis is the fourth most costly fiscal event in British fiscal history, going back to 1700, after the Napoleonic War, the First World War, and the Second World War. The economic costs, as I'm going to show you in a minute, have been huge and permanent. It's devastated confidence and had a profound effect on our economy. The cost of the crisis to the credibility and legitimacy of political, administrative and financial elites has been, in my view, devastating. This is a central point of the last chapter of my book, which has just been mentioned. And in my view, the loss of credibility and legitimacy of political, administrative and financial elites is one of the main reasons for the explosion of populism of the right and left. And I would stress particularly that of the right, which has now taken hold in the United States, the most important of all democratic countries. So I think without the financial crisis, Mr. Trump would not now be president. So one simply cannot exaggerate the significance of these shocks. Now, I said I would say a little bit about the economic consequences of this crisis. This is a pretty simple chart, and often simple pictures tell very powerful stories. So what I've done here is I've taken IMF figures for the GDP of the advanced economies starting in the late 1970s. The red line is actual. The green line shows the 1979 to 2007 trend, that's the pre-crisis trend, extrapolated forward. And the blue line, and you can read that off the right-hand scale, is the proportionate shortfall of the actual and projected GDP from the pre-crisis trend continuation. And you can see that by today, 2016, the developed countries as a whole have a GDP which is roughly a sixth smaller than it would have been if the pre-crisis trend had continued. And by 2020, it will be 20%. Now, I don't want to suggest that the pre-crisis trend was necessarily sustainable, but it is worth noting there is no sign in that trend of any exceptional upsurge before the crisis. What seems to have happened, rather, is that the whole structure and development of demand in our economies was entirely unsustainable, being associated with the debt accumulations. And when this broke down, it precipitated a collapse in GDP and in confidence, in investment, in productivity growth that has put us in a completely different growth trajectory from that before. This is not exceptional. It's happened in many, many previous financial crises. So that's the main thing I wanted to say. It is impossible, reading that story, not to feel that this is a cost that you should be desperately unwilling to pay again. Now, what is the response of the system? What have the system tried to do? Because after all, everybody has realized something has gone very seriously wrong. Well, the essence of the official response, as I say here, has been to maintain today's system while tightening regulation and imposing tougher penalties on misbehavior. And regulation is extraordinarily comprehensive and intrusive. It covers just about every aspect of the behavior and performance of these supposedly private, profit-seeking, competitive business. It covers the amount of equity capital they're supposed to have in astonishing detail and complexity, with variation in the line of, in context of the business cycle and everything else. It includes their liquidity requirements, the nature of their liquidity to deal with runs. It includes resolution procedures to deal with firms that are no longer solvent as currently structured, and that has brought about a very detailed intervention in the structure and nature of the debts of the banks beyond deposit liabilities into all sorts of other forms of debt, COCOs and all the rest of it. It has involved radical changes in industry structure, including the ones I mentioned, the ring-fence requirements, which are essentially designed to segment bits of the bank from other bits of the bank in order to make them, in theory, more stable and, above all, easier to resolve. It has included radical interventions in industry incentives via controls on bonuses, pay, managerial responsibility. In the UK, we call this the senior persons regime, and includes, of course, massive quantities of fines paid by shareholders, overwhelmingly borne the cost by shareholders in the light of the immense number of scandals that have come to light during and since the crisis. And finally, there is a radical overview being taken of industry behavior, notably via so-called Macro-Prudential Regulation, which tries to oversee the financial system as a whole. So the solution we've chosen to the problem we have with the financial sector, since we don't trust it at all, and these regulations demonstrate we don't trust it at all, is to essentially regulate everything. Regulate almost every aspect of their operations, and I haven't even talked about the day-to-day and intrusive supervision that most major banks now suffer. Now, I believe these reforms will ultimately fail, and perhaps the best reason for that is captured in my first few notes. Governments so mistrust finance for quite understandable reason, that they have decided to regulate almost every detail of the behavior of these immensely complex and huge institutions with their still gigantic balance sheets. But they also insist banking is a private, profit-seeking business. The tension is quite obvious. But in practice, it's now viewed as pretty well a branch of the state, albeit one that continues to afford huge opportunities for private gain of the successful participants. But I think it is more realistic, though very controversial, and I made this point already in 2010, to view bankers as exceptionally highly paid civil servants. While highly intrusive, of course, it should be stressed this regulation is not without benefits to incumbents because it makes it very difficult for new banks to engage and therefore for the competitive process to work in finance. I think the capital standards are an improvement, but they still rely on this core idea of risk-weighting assets, and I'm going to come to this in a moment. In order to judge how much capital banks need, the basic way of doing this, the core way of doing it, is to risk-weight assets on the assumption that we can risk-weight assets, that is to say, we know what is risky. And it is important to remember that all financial crises happen because what previously were thought were relatively safe turn out to be very risky. I'd like to give you a very powerful example of that, which is, I know to my own personal satisfaction, basically no serious economists that I knew in the United States in 2005 believed that it was possible for there to be a general fall in house prices in the United States. They believed this was impossible. And because they believed that it was impossible, it was quite reasonable to give incredibly low risk weights to anything associated with that possibility. Essentially, it was ruled out by assumption. And that's exactly the circumstance in which a mania occurs, which leads to overlending and finally collapse. Mistaken confidence in our understanding of risk in a world which is in fact highly uncertain. The overall leverage of banks, on which I tend to pay more attention, remains, and this depends on the system, but in the UK, about 25 to 1. These are fantastically highly leveraged businesses still, if you look away from the risk weighting. Liquidity requirements are designed to deal with runs of about 30 days. It's perfectly possible for a run to last much longer than that. In fact, one did run that lasted for many months, basically destroyed a British bank called Northern Rock. Ring fencing, of course, which I propose, can help. But in a crisis, as we know very well, retail banks, which is what we're ring fencing, can also fail. Indeed, that is exactly what happened in Ireland. I want to make the point, though I'm told things are better now, just how misguided risk weighting can be from what happened in Britain before the crisis when the banks were allowed to use their own risk weights. And remember, they were supposed to be the most sophisticated managers of risks in the world, the people who knew what to do about it. So the red line here is a measure of the estimates of riskiness of assets made by the banks themselves in the years between 2000 and 2008. And the less risky the bank assets are believed to be, the less capital they need, because essentially the less riskier they are, the more the assets they have to hold capital against diminish in risk weighting, in risk significance. And you will see that in the run-up to the biggest financial crisis in British history, the biggest financial crisis in British history, the risk weights collapsed. That is to say, the banks decided in their great wisdom that never before 2008 had bank assets ever been so safe. Ever. There was no risk at all. And as a result of that, they could immensely increase their leverage, and that's the black line. It shows the leverage exploding. And the result of that, which is very fascinating, is that before the crisis, the British banks, which were about to be rescued, all reported that they had never been so well capitalized. They were completely safe. Enough said about risk weighting. Do we do better now? Probably. Can we really rely on this? For reasons I've explained, No. Resolution is another idea, and it's indeed a core idea in the Eurozone. And the idea here is that if a bank gets into difficulty, we will force creditors to take losses. This will convert debt into equity. It will be therefore ensure that creditors bear the losses and there's no government bailout. And I think for individual banks in severe difficulty, this is a perfectly workable solution. But if lots of banks are all in trouble at the same time, the idea that we're going to pull them all out, turn debt into equity, whatever that does to the credibility of the entire system, isn't plausible. It's not time consistent. And creditors know this. For this reason, risk will be taken, making crises more damaging and a bailout more likely. It's very difficult to pre-commit yourself to a resolution response in the middle of a world-class crisis. And secondly, resolution can cause crises, particularly if it damages vulnerable creditors elsewhere in the economic system. It depends on who the creditors are. Again, controls on pay and other internal incentives are desirable, but bankers are in truth experts at getting around such curbs, and they are far more motivated than the regulators. Finally, macro-prudential policy, which is a core element of the new system, which is the idea of managing the risk of the financial system in aggregate by a centralized committee, in the case of the UK, so-called Financial Policy Committee within the Bank of England, raises very difficult challenges. This involves affecting the capital ratios of the banking system as a whole, changing loan-to-value ratios and other details of loans throughout the system. It's basically managing the entire riskiness of the system. I think the interventions will be difficult to judge. They will often be politically unpopular since they're designed to cool booming asset markets, notably housing markets. They can easily conflict with monetary policy, namely the central bank wants to expand the economy by lowering interest rates, and at the same time it wants to stop the financial sector from taking risk. That's pretty obviously going to cause a massive conflict. They can have unintended consequences. We don't fully understand how this is going to play out. And above all, it seems to me really weird to think we have a private sector market-driven economy when the riskiness of the core system of the market economy, the financial sector, is being managed by officials, not finance itself. So I'm very skeptical the macro-prudential regulation will work, particularly in good times when pressure to relax regulations is strong. And this means that regulation always and consistently tends to be highly pro-cyclical. Too loose in good times and too tough in bad times. And indeed, again, we've seen this very clearly over the last 10 years. So where do we go from here? My concluding remarks. The emergence of an immensely highly regulated, yet cosseted, notionally private but publicly backed financial system, which is what we have today in most of our countries, and certainly in the UK, is, I think, a perversion of a market economy. The banking system has become the private beneficiary of a public function, the creation and management of money. It is precisely because money is so essential to us that we cannot allow the financial system to collapse, and not just for people with insured deposits, also with businesses. Everybody wants to make payments. They need the money in the banks to be safe. It is able, unfortunately, to use the spectacularly huge resources at its command to lobby against regulations it does not like. It will succeed in that. And indeed, with the election of Donald Trump, in my view, it has already succeeded in that. And it is almost certain that over the next 4 or 5 years, many of the regulatory tightenings that I've mentioned will be removed, reduced, or at least substantially watered down in the US, and Europe will follow it, preparing the grounds for the next crisis. We should consider moving instead to a system in which the government creates money directly, making the monetary system safe and secure, and allowing us at least to move towards, with all the difficulties I know it creates, towards a system in which finance can again be a proper part of the market economy. Thank you for listening.